Look over here. What do we have? All three of these candles here. 1, 2, 3. The order block begins with this candle's low. It's 1, 2, 3 candles making one consecutive bearish order block. Some of you are commenting in the section of the video saying, I thought I understood order blocks, now I'm confused. Because you're hearing people parrot what I've said in certain circumstances, and they don't understand what an order block is. Okay? This is why I get upset when people try to teach what they heard me teach about 1 or 2 times, and the buzzword is what's being tossed around so that way people can sell their courses and get clicks on their videos. You have no idea learning about order blocks from anybody else on YouTube. I'm going to make it very plain and make a blanket statement right there. I'm not trying to hurt anybody's feelings because I know a lot of you out there that try to talk about order blocks. You have a lot of respect for me, but I'm trying to correct you because I know you have a large audience, and some of you have a very large audience, and you're doing things that are not accurate. Okay? So I know you're watching my videos, so that way you'll correct what you're doing, so that way your viewers won't be harmed, or they won't use something that's done incorrectly and dubbed as my order block. And if they have hardship or difficulty doing it, it's not going to be attributed to the concepts being effective, because they are effective. It's just they haven't been taught properly. Okay, it's easy to talk about it in hindsight, but it's real hard to do it in real time unless you know what you're doing. So the logic is we ran up into this daily fair value gap. That's what this level is up here. This red line was those relative equal highs on the hourly chart. Remember that? And you're probably going to need to watch this video a few times because I've gone through a lot already. But I'm breaking down the market. And this run here is the run into that imbalance and above the relative equal highs. So this is the bearish order block. It's the consecutive run on this time frame, the 5-minute chart. It does not need to get up into this last up close candle before the down close, because that's what everybody says an order block is. It is not that. Notice it doesn't even get up to that, does it? Why? Because what I'm showing you here, what makes an order block valid? It has to have an imbalance. Without the imbalance, there is no order block. That's why it's not supply and demand. Okay, there are specific rules. I'm going to cut through candles. Supply and demand requires fresh zones. Okay, that's nonsense. I have no affinity for anything like that. I'll cut through fractals and go through and find something over here and still trade on it. So it violates the supply and demand theory right there. So that's the distinction, and why I laugh at people that say, oh, he's teaching really nothing new. I'm really teaching you something that no one's talking about. Unless I talk about it first, they're saying what I said. And not to sound egotistical, I'm not trying to be egotistical, but I want you to learn it correctly, folks. Okay? I only want to see you do it the right way. Because if you do it the right way, you will find the results you're looking for. If you don't want to do what I'm teaching, you're not going to be consistent, you're not going to find longevity, and you're going to get frustrated, and you're going to think that this stuff doesn't work because you didn't learn it properly from the person that created it. The order block is all 3 consecutive candles. The reason why this last up close candle is not even traded to is because the higher time frame parent imbalance, that 15-minute time frame, which is being shown here, that range of that low and that candle's high here, it stops there. So there's no necessity for it to trade up into that last candle. So if it trades up into this candle here, the bottom one, the last one of the 3 going up, that's enough for me, and take that over here, and then we have this imbalance. So in my mind, this imbalance is sufficient. We don't need this one, and you wouldn't expect that last up close candle to be traded to. So this is the ideal scenario that I think the mentorship on YouTube should be looking for. Now, as soon as you have this, this is one you settle in on, what are you met with? Another little fair value gap right above it. So what were the rules that I gave you when it has that in the chart? Think. It is going to be a likelihood that it could trade up in there, but your limit order to enter is down in here. Because it might not get up here. What am I trying to do? I'm trying to teach you how to avoid missing trades, because a lot of you are going to want to put an order up in here, and yes, it would have been filled on this instance, but many times you're going to have an order placed at a really overzealous price point that if you nail it, it's beautiful, but they don't happen a lot. It's fleeting. It happens once in a while. So I'm trying to give you something that it allows you to operate consistently, gives you lots of setups that will allow you to practice, also back test like I'm showing you here. It's just how you back test, because this has already happened. But these are all the things that I'm teaching you in this mentorship, and I talked about this level here in my own private group beforehand. And you also knew about the bias being bearish on this pair from Tuesday's trading. What's the order block that you trade for, Michael? What's the right order block? How do I pick the right order block? I just answered it. What is an order block? It's a change in the state of delivery. The algorithm changes its state of delivery. As soon as we get below this candle's open, the market starts delivering sell side. And then it breaks this swing low. So now we have changed gears internally. Any rally after that is just setting up another run to go lower. So in other words, this is a suspect rally. Okay? So this is an intermediate term high. Swing high. Because it has the imbalance. It should not trade higher than that high. That's the reason why I'm telling you, you can put your stop loss there. You see how the rules are coming together? I'm not complicating it. I'm literally telling you everything I've taught, and I'm putting it into the chart. Everything was said before it happened. And here it is. It's the framework, it's the logic, and I'm teaching you with great detail that you otherwise would have never learned. So I'm taking you in over top the chart, giving you the framework and giving you the logic. I'm giving you the what if this, what if that conditions. Okay, I'm telling you how to negate certain order blocks that you would otherwise expect to see it trade to because of different YouTube channels or other people trying to teach my stuff, and they don't know what they're talking about. Okay, they have no idea what they're doing. This setup here gives us a nice opportunity to get short. So you could be a seller here on a limit entry. So you place your limit order here and you just walk away from it. You let it go. Now, what happens if it doesn't fill you by 11:30? Pull the order. It's it. Don't put it good till cancel. Just pull it, because you want to be entering on the day that it creates this. Because relative equal highs, if it doesn't drop off, it could come up at a time of day where you don't really want to be there, and it could fill you, and then keep on running and take out the relative equal highs at a deeper pass and then stop you out.
Okay, let's take a look at a supposed support line. Now that can be in the form of a old low on a long-term or higher time frame chart. It could be an old high where price has moved above recently and now we're trading back down into it. So simple support and resistance ideas are just enough here. But the main thing is you want to be using it on a higher time frame charts like a monthly, weekly, or daily. And eventually you'll see price trade down into this level that you identified as a support level. Once price trades down into the support level, and it could trade to it or just through it, doesn't make a difference. But what we're doing is we're waiting for price to show us indications that smart money or a large body of big flows, or those individuals that are on an institutional level that have a whole lot more collectively than we do in terms of money, when they participate in a move, it'll be seen in price action. So when we have this down candle, we have already assuming that this may be a bullish order block. We don't know that yet until at a later time when another candle trades through it. What are we specifically aiming for? We're identifying our focus. The down candle's high, when that is violated with a new candle and it trades through that high, now we have a validated bullish order block. This candle validates the down candle as a bullish order block. Now, at this moment, if we trade back down, once that down candle or suspected bullish order block's high is violated, we can now highlight that candle's high, and even in the very candle that broke that down candle's high, if it trades back down to that down candle's high or the bullish order block's high, that could be a retraded price that which we could day trade off of or enter our longs early. In other words, we don't have to wait for a later time for it to trade back down into this level. Eventually, price will run away. At this point, if you didn't enter on a retrade at the bullish order block's high, you're simply going to be waiting for price to want to pull back. Now we have indications that there has been displacement in the marketplace. That means someone with a whole lot of money and a whole lot of interest wanting to see higher prices is now in play. They are participating in the marketplace. This is the evidence in price action that you have institutional sponsorship behind the move. Large flows or institutional traders have the capacity to move price, whereas we as lower grade traders in terms of retail or smaller traders in terms of in respect of a bank or a large entity in an institutional capacity, we can't move the marketplace, but they as a whole collectively can. So what we do is we wait. We're patiently watching price. We anticipate price to start to retrade back down into that down candle or bullish order block's high. At this moment, we can set alerts. We identify the high on that candle. Now I'm using the bodies of the candles. You may end up using the wick, but I want your focus primarily on the bodies of the candles. And when we talk about wicks, I'm going to overlap order blocks with fair value gaps because that is going to be the answer to many of your questions as to relates to when do we use the wicks and when do we use the bodies of the candles. But primarily I want you focusing on the bodies of the candles when we're talking about order blocks as a whole. So at some point when we see that level, okay, that high of that order block, when we're close to it, we can now set an alert. We can set our platform to remind us with a text to our phone or email us or however it is that you would be alerted by your platform. Some platforms have pretty sophisticated means of contacting you. Others is just simply an audible alarm that goes off on your computer to draw your attention to a specific market. But until then, you're going to submit to time. You're waiting. Now, this is sometimes the hardest thing to do as a trader. What we're actually looking at is internal range liquidity. Now, when we're trading inside the range, and that range is defined here, what we're looking for is an expansion up and to a known level of what? What's up there? Well, that's going to come in the form of external range liquidity. That external range liquidity is where we're going to be looking to offset some or all of our long position. Now we identified the buy level. We've entered the market. Before we do this, what we should have had in mind is ideally where we're looking to take our profits. That's up here above an old high, and that's going to be in the form of buy stops. So if we're buying or entering long inside of a known range at a bullish order block at internal range liquidity, we're buying the liquidity that's offered at that level. We're going to be looking to sell our position to willing buyers in the form of those individuals that hold buy stops above that old high. That's all well and good for profit taking, but what do we do for risk? We take our attention back down to that bullish order block because it's going to give you everything you need for your trading plan. We identify the entry at the open of the down candle. That's our buy point, or 5 pips above it. But we want to focus our attention in the midway point of that down candle. That's going to be in the form of the mean threshold. Ideally, the best order blocks will not see price trade down below the midway point of the entire body of the candle. You're going to measure the open to the close on the down candle to measure where the middle of it is. Do not use the wicks. Don't use the very high or the very low. Measure your Fibonacci level. 50% level or halfway point is the mean threshold on a bullish order block. And same thing said with a bearish order block, but you just don't want to see price drive down deeper than the mean threshold by very much. It can stab through it just by a little bit, but we primarily don't want to see it trade down there at all. The better order blocks won't do it at all. And your protective sell stop is going to be below the bullish order block's low or below the close. Now at this point, depending upon where that low is, it could be the low of the wick, but primarily you're going to be looking at the low formed by the close of the body of that candle. Now again, focusing on what we anticipate in price, eventually price should show a responsiveness and trade up and through our old high. When that happens, you're going to be looking to take partial profits or all your profits, depending upon how big that move was and how much profitability you've obtained. What you're actually trying to do is you're going to be pairing your long exit with willing buy stops. And that is essentially bullish order block trading in a nutshell. It's been complicated by many people on the YouTube that's adopted it, and those that want to use it on Twitter and on social media, they've shared several ideas. But I want to focus on the simplicity of them here, and then we're going to graduate into more teaching later on in this month